You have worked 20, 30, 40 years of your life. You scrimped, you saved, you skipped vacations, and you finally did it. You looked at your 401k, your IRA, your brokerage statements, and you saw that beautiful, shining number, $1 million. You think you've crossed the finish line. You think you are safe. But then, in the dead of night, that cold spike of fear hits your stomach, doesn't it? The question that keeps you tossing and turning until 3 in the morning, what does that $1 million actually mean when the paychecks stop? What does it translate to when you need to go to the grocery store, pay your property taxes, or keep the lights on? You are terrified that you are going to miscalculate, make one wrong move, and watch that hard-earned nest egg vanish into thin air, leaving you broke and dependent on your children or the government. I am here to tell you that your fear is justified, but your ignorance is not. Today, we are stripping away the myths, the Wall Street lies, and the dangerous assumptions. We are going to calculate exactly what a $1 million portfolio generates in monthly income, because you cannot afford to guess. Let's start with the absolute baseline truth that almost everyone gets wrong. If you think having $1 million means you can just pull out $50, $60, or $70,000 a year because the stock market averages 8%, you are playing Russian roulette with your financial future. Why? Because of a monster called sequence of returns risk. If you retire and the market takes a massive downturn in the first 3 to 5 years of your retirement, and you are pulling out large chunks of cash while your stocks are plummeting, you will kill your portfolio before it even has a chance to grow. You will deplete the principal, and ladies and gentlemen, once the principal is gone, the game is over. So, how do we protect you? For decades, financial advisors pointed to the traditional 4% rule. They told you that if you take 4% of your portfolio in year 1 and adjust it for inflation every year after, your money will last 30 years. 4% of $1 million is $40,000 a year. Divide that by 12 months, and you are looking at exactly $3,333 a month. But I want you to wake up and smell the coffee. We are living in a completely different economic landscape. Forward-looking data and major research institutions, like Morningstar, have adjusted those numbers. They look at current equity valuations and volatility, and they suggest that a truly safe baseline for a rigid, fixed, inflation-adjusted paycheck over a 30-year horizon is closer to 3.9%. If you are 100% in stocks, one bad market year ruins you. If you are 100% in cash, inflation eats your purchasing power alive, and 10 years from now, your $1 million will buy half of what it buys today. To safely generate monthly income, your portfolio needs to be structured like a well-built house. You need an income basket and a growth basket. You want a portion of that $1 million, perhaps 30 to 40%, invested in high-quality, dividend-paying stocks and real estate investment trusts, also known as REITs. These are companies that legally must pay out a massive portion of their income to shareholders. A solid dividend and REIT allocation can easily generate a reliable 4% yield, giving you thousands of dollars in passive income without you ever having to sell a single share of your underlying stock. Then, you wrap that around a high-yield cash reserve and short-term bond ladders to act as your dry powder, your safety net so you never have to sell your stocks during a market crash just to pay your monthly bills. But let's look at the bigger picture, because your $1 million portfolio does not live in a vacuum. It is only one piece of your retirement puzzle. The ultimate way to supercharge what your portfolio generates is to optimize your other income streams, specifically your Social Security. I see so many people rushing to claim Social Security at age 62 the second they stop working, simply because they are afraid the money won't be there later. Hear me now, for every single year you delay claiming Social Security past your full retirement age up until age 70, your guaranteed monthly benefit increases by approximately 8% per year. 8% guaranteed by the United States government. You cannot find that kind of guaranteed return anywhere else on Wall Street. If you have a $1 million portfolio, use a portion of that money as a bridge. Withdraw a little more from your portfolio between the ages of 65 and 70 so that you can let your Social Security benefit maximize. Once you hit 70 and that massive, maximum Social Security check starts hitting your bank account every month, the pressure on your $1 million portfolio drops drastically. Your required withdrawal rate will plummet, ensuring that your remaining savings will last not just 30 years, but for the rest of your natural life. Your actionable takeaway today is simple, and I want you to do this immediately. Stop looking at your retirement savings as one big jackpot number. Sit down with a piece of paper and write down your exact, non-negotiable monthly living expenses, your housing, your healthcare, your food, your insurance. Then, subtract your guaranteed income streams, like Social Security or any pension you might have. Whatever is left over is your retirement income gap. That gap is what your portfolio must fulfill. If that gap is less than $3,300 a month, you are in the safety zone with your $1 million. If that gap is $4,000 or $5,000 a month, you have work to do. You either need to work a little longer, adjust your lifestyle, or commit today to using a flexible guardrail strategy where you actively manage your spending based on market conditions. Do not let fear paralyze you, and do not let complacency blind you. $1 million is an incredible achievement, but it is only as good as the strategy you use to distribute it. Be smart, be disciplined, be flexible, and above all, be safe.